I believe today's decline is the biggest in more than 6 months. It may be overdue to an extent. We've had a nice rise of 36% since the April lows, but I'd say the market seeking safety. I would like to say the market is, concerned. Unless there is a real structural change, this pullback is a buying opportunity. It shows you that investors are seeking protection. And as you know, the VIX is a measure of expected volatility of the largest 100 stocks. And so a spike in the VIX is really a market saying, okay, I need to get out of everything, but I can't sell everything. So let me hedge it by buying volatility. That is usually a sign of an interim low. I mean, I don't want to say I think markets are bottoming today, but we know that the forward returns are pretty good 1 month and even 1 week later. So I would say if someone says, are we higher a week from today? I'm going to say the odds are actually really good.
Today, as the market crash has investors worried, the crypto market also crashed, with Bitcoin falling to $108,000 and Ethereum dipping below $4,000. As crypto investors continue to speculate as to whether we'll see a price drop in Bitcoin and Ethereum in the coming weeks, this crypto cycle is heating up, and Tom Lee remains bullish, with a parabolic rise in the last few months of 2025. Forced selling, leveraged bets, and the usual tug-of-war we see when an asset approaches such a huge barrier. The bigger picture looks very different, though. Analysts are drawing a striking parallel. Ethereum today may be in the same position Bitcoin was back in 2017, when it rocketed from $1,000 into the financial spotlight as Wall Street started paying serious attention. And just like Bitcoin back then, Ethereum is now catching the eyes of institutions, hedge funds, asset managers, and major investors who see its role extending far beyond speculation. Bitcoin has been trading more like a risk asset lately, meaning if the market recovers, Bitcoin is expected to surge alongside it. But the uncertainty is key here. If the market remains stuck in limbo, Bitcoin could face short-term pressure. The community is buzzing, and adoption is spreading across industries from decentralized finance to stablecoins. Even the regulatory environment, often seen as a stumbling block, may be tilting in Ethereum's favor. That makes Ethereum more than just a digital currency. It positions the network as a backbone of future financial infrastructure. And as Tom Lee points out, this is likely just the beginning. With Wall Street's deeper involvement and retail energy still strong, Ethereum's growth story has room to run. The question now isn't if Ethereum will climb higher, but how fast it can write the next chapter in crypto history. Let's get right into the latest interview with Tom Lee, as he gives his market prediction for the days and weeks ahead.
I think markets are trying to balance a few things because we are navigating a little blind because of the government shutdown. But we also know that the real powerful driver of the equity market and the economy has been AI, which is not affected by this slowdown. So I think stocks are in this sort of zigzag pattern, but given we're in that seasonal period from October to year end, and we think the S&P can get to at least 7,000. It has been, and we've seen it this week. These pullbacks get bought, so we could be weak today, and I think we could rally tomorrow. And in general, I'd still be bullish into year end. I do think markets are less skeptical than they were in April and even in August and September, and we can see this in both positioning and AAII. So I think it is fair to say that the markets have priced in more good news. So like the things you flagged can be worrisome. But what I'd point out is that I think the AI story is actually strengthening, Scott. From our conversations with both companies and investors, it actually seems like the payback for AI, whether it's applications or services or companies' actual ROI, actually has improved in the last quarter or so. So I think that's what's helping actually create demand for spending. So I think we may be underestimating the sort of profit creation coming from AI. And I think that's why there's still legs to that story. But you're right, on balance, the data is mixed and we don't really know because we don't have government data. There's this thing where people can make like a backhanded compliment, like they might say something positive about the market, but they're really bearish because when I hear people say, oh, well, this reminds me of 1999, or, they're ringing the bell on the top of AI stocks, they are maybe acknowledging that the market is strong, but then they're trying to mark the end of that rally. And I think, for me, who was an analyst in the 90s, people forget that Cisco in September 98 was at almost a 60 PE when the Fed made its first cut in 9 months, and then its PE went to 200. NVIDIA is that stock today, and it's trading at around 27 times forward earnings. I mean, it's got a lower PE than Walmart and Costco, which are like 35 to almost 50 times. So I just think a lot of good news has been accepted by markets, but I don't think it's necessarily priced into markets. As you know, retail is really the cohort that saved the market in April because they were buying that dip. Um, the other three cohorts in the market are, of course, institutional, and then there's international, and then what I'd call family office and super high net worth. Of those three, I think institutions have been reluctant and now are allocating in the fourth quarter because there's beta, and this has not been a great year for many stock pickers. So this fourth quarter is their chance to catch up. On the international, as you know, much of the flows were out of the U.S. and into non-U.S. stocks, and that's beginning to reverse. And then on the high net worth, I think there is still a stubbornness about being skeptical of stocks, and that's why I think there's still what we call the most hated V-shaped rally. The retail has not hated this rally. They have been buying since April. I think that when we look at the balance of flows, as you know, the U.S. has outperformed non-U.S. for more than a decade, and we are seeing a little bit of catch-up here. But one of the things that I've been finding as I've been visiting with international investors, and next week I'm actually in Latin America visiting clients, is that investors are buying non-U.S. because of valuation, but the E part of the non-U.S. isn't really as attractive because the U.S. earnings growth is getting a big tailwind from AI and the leadership from not only just AI stocks, but also U.S. financials. And so I think the earnings story is what's causing some of these who've made non-U.S. as a factor bet, realizing that you got to still have a lot of E to support this move. And so I think that that's why you're going to see that as a tailwind into 2026. Because I think visibility is much better. Tech is not the pure cyclical group where you actually sell it at low PE and buy at high PE. This is a group that you buy because there is visibility. And I do think that the PE expansion isn't going to just be tech going forward, Scott, because the ISM, and you guys had this conversation just now, has been below 50 for 31 months. That is a big percentage of S&P earnings that can accelerate when confidence recovers, and that is actually likely going to pivot as the Fed embarks on a cutting cycle. So I think tech has been the leader. I do think market will broaden. So, as people stay reluctant, I think there's still a lot of upside into year end.
Ethereum isn't just holding its ground, it's starting to pull ahead. As 2025 winds down, Ethereum has actually outperformed most other major crypto assets, driven by record on-chain activity, surging developer adoption, and growing institutional demand. While Bitcoin continues to anchor the market, Ethereum's momentum is signaling that it could be a real leader in this next phase, setting the stage for what analysts call its strongest run yet. Embracing an unyielding enthusiasm for the Bitcoin realm, Tom Lee confidently predicts that explosive growth is looming on the horizon, as BlackRock and many other crypto giants are doing just that. Tom Lee reassures that a long-expected surge awaits. By the end of 2025, there will be 1.1 billion active crypto wallets. The pace of growth is hard to comprehend, and it will be the fastest accumulation of wealth we have ever seen. This is the conclusion of a career's worth of research. And every single chart and piece of research leads to the same conclusion. Liquidity drives everything, and crypto will be the best performing asset of them all.
Frank, I think there's two underlying fundamental drivers for the economy. One is that we know there's a tremendous capex tailwind from AI. And the second is that the Fed's been on hold for 9 months, and it's kept the ISM below 50 for now 31 months. and the Fed's dovish. So that's the rest of the economy getting basically a lifeline. Those are going to be powerful tailwinds that even a government shutdown doesn't really change the story around. And now that we're in the seasonally strong fourth quarter, and valuations, I just don't think are that demanding because, NVIDIA is still at 26 times earnings. I mean, I think stocks still have a lot of upside into year end.
All right, really quick. You're talking about ISM manufacturing, right? Still in contraction. You're saying the Federal Reserve rate cuts, if we stay on this path, that boosts the manufacturing sector. Is that the point you're trying to get to?
Yes, that's right.
Okay.
So the manufacturing sector has been cautious for 31 months, the longest stretch below 50 in history. And, that's business confidence. It's highly correlated with earnings growth. So I think once that moves above 50, that means we're back in expansion mode, and it's good for financials and small caps, and the tech trade continues. So I think it's a broad-based rally.
I think a lot of people think it would be good for transports, energy prices. I think, as you mentioned, it would have impacts across the board if we see a boost in U.S. manufacturing. Okay, I want to get to your word of the day. It's dovish. Now, this is interesting. Your word's dovish, and you're dovish because the Fed didn't get the jobs report and might not get other reports. Why are you dovish, or you think the Fed's dovish, despite that critical information?
Well, the Fed has, I think, on balance, has to be more dovish than what they said they would be last month, because a government shutdown, as you know, disrupts economic activity. So even though they're not getting reports, there's also a standstill in GDP, and the government is a very large share of GDP. On top of that, it causes confidence to be weaker. A shutdown makes people nervous, and so the Fed will have to be even more dovish, and I think that's why stocks can rally even more than they have already.
All right, you're also looking at seasonality. You alluded to it earlier. According to your data, since 1950 in Q4, we see just about an average rise of about 5%. But when we're talking about seasonality, are you sure this isn't an outlier year? As we mentioned, a government shutdown, companies trying to deal with tariffs. We're seeing a trade war between the U.S. and China continue. It hasn't quite been resolved yet. I mean, aren't there some issues that could maybe shake the seasonality here?
Yes, that's right. I mean, seasonality is just a base case, so things can make it different. But this year, we're going into the fourth quarter where sentiment, I think, is still really muted. If you look at things like AAII net bulls, it's barely positive. After a 30% rally in stocks, historically, you'd be solidly positive on a 20-week moving average of that number. Investors have really been skeptical this entire rally. That's why we call it the most hated V-shaped rally.
All right, I want to get to your pick as well. Your pick for us today is financials. Now, is this on the idea that the Fed is dovish, rate cuts help, boost the yield curve, and that helps financials, or is there some other reason that you're saying that you would put money into financials right now ahead of earnings?
Well, I think financials have also fundamental tailwinds because we know the Fed is going to be dovish, which is helpful for economic activity. But on top of that, AI is a tool that the financials industry can leverage. It's going to help them root out fraud. It's going to help make their businesses more profitable. And it's something we've talked about at Fundstrat, which is the financials may end up getting technology valuations, especially given blockchain and moving from traditional financial rails onto blockchain and becoming more efficient.
All right. You're also a big believer in Ether. So you're saying financials companies especially, you say, are building on Ether. Is that a tailwind somehow?
Yeah, absolutely, Frank. Keep in mind, Exhibit A in all this is Tether. It's the largest stablecoin issuer in the world. It's valued at $500 billion, or about 25 times earnings. It makes it the second largest bank in the world behind JP Morgan. And it shows you that by building on the blockchain, a business can really reduce cost and be a lot less employee intensive. Tether only has 300 employees compared to JP Morgan, which has 313,000 employees. Okay. So Tether is valued at around $1.8 billion per employee. JP Morgan around 2.6. Okay. So you can see the leverage coming from Ethereum.
Where does all of this leave us? Ethereum has crossed $4,000, weathered short-term volatility, and is now attracting the kind of institutional attention that once catapulted Bitcoin into the mainstream. Analysts are increasingly framing this as Ethereum's 2017 Bitcoin moment, where the groundwork laid over the past decade finally meets global recognition and capital inflows. But here's what makes this cycle different. Ethereum isn't just competing as a digital currency, it's the infrastructure powering decentralized finance, stablecoins, and entire ecosystems of applications that regulators and institutions are beginning to take seriously. That combination of utility and adoption is exactly why many see $5,000 and beyond as not just a price target, but an inevitable milestone. Over the past year, Ethereum has quietly outperformed most other major crypto assets. Tom Lee and other top analysts emphasize this point. Ethereum's real growth story is still ahead of us. With Wall Street leaning in, developers innovating faster than ever, and adoption spreading across industries, Ethereum is positioned to be a defining force as we head into 2026. The bottom line: the short-term swings may grab headlines, but the long-term trajectory is unmistakable. Ethereum is evolving from a promising blockchain into a cornerstone of digital finance and technology, and if history is any guide, the breakout we're seeing now could be just the opening chapter of Ethereum's biggest run yet.